Well, hello, everybody. My name is Alex. Thank you for joining. A little bit about me. I've been in the business since 1997, and I live and breathe real estate. I've been in the business since 1997. I'm a licensed mortgage loan originator, a title agent, and a real estate broker. Also on a credit agency. I'm the broker owner of Bluecastle Lending, Realty, and Title. So I'll be able to help you out with your real estate needs. If you have any personal questions, the only reason why we do these webinars is to create a relationship with you. Please call me 954-866-0000, 954-866-0000. You book an appointment. You're not wasting my time. Even if you're not ready to buy yet, during the appointment, we can learn how much you could qualify for really without running credit or doing a loan application. And if you're not ready to buy yet, we can learn how to overcome. You can learn how to overcome your situation challenges for credit, for income, for assets, or even finding your home. Anyway, so what are the most common buyers' mistakes? Mistakes that cost you a lot of money, mistakes that when you buy a house, you pay. And I would say that the number one mistake is that people want to wait to save more money. And in the process of doing so, they end up, the property values keep on going up, and they end up saving much more or less than the money they are spending. For example, I'm going to ask you two questions, and you don't have to answer, but keep it in the back of your mind. How much can you save per month? Is it 1,000, 1,500, 2,000, 500? Answer that question to yourself. The next question I'm going to ask you is, how much are you paying in rent? Most people are able to save $1,000, $1,500 a month, but then they end up paying $2,000, $2,500, $3,000 in rent. So the math never adds up. Also, let me share the screen with you. I'm going to show you how many people in today's market are thinking that the property values have gone down or are thinking of going down. Hold on, let me share my screen and I'll show you. I've been tracking the property values since for forever. There we go. And just going back to 2022, what you see here is the total active of listings in Broward County single family homes. So on this particular date, March 28, 2022, I'm sharing my screen, correct? Yes, no? Yes, I am screen sharing. Okay, good. Glad to know. All right. So on March 2022, there were 1,381 single-family homes for sale in Broward County. So this is, I don't know if you guys remember when property values was going up and up and up like crazy. These are what was happening in between. And here you can see, like in this particular time, the median sales price that happened at that time. So at that time, it was $575,000, the median sales price. This is for March 31st, 2022. And at this point, the listings is starting to go up. The number of properties on the market started to go up. As we go up in time from 2022, and we bring it down, you see here the total active listings keep on going up. But so, I don't know if you remember, right, that this number down, we have here 575,000 as the median price. Property value, inventory keeps on going up. And the theory is once it reaches 6,000 single family homes for sale in Broward, that's when the value may drop. So that's what I was tracking. I wanted to know before it happened, when is the value going to go down? And as you can see, even though the inventory kept on going up, and here it decreased, The value keeps on going up, essentially. And it fast forward to this year in 2025. This I just did before today. And the median sales price is 615,000 comparison to, this is November 6th, versus compared to in 2024, you had a median sales price on November 1st of 615,000. So it didn't go up and it didn't go down. The property value did not go down. But what has happened since June this year, the inventory started to go down. So here you have, you almost reached 6,000 units, but then the rates went down, and this is what started to happen. So the inventory at this point, it's going down. So waiting, it's never gonna get you the house that you want. It's not gonna get you what you want. The mistake number 2 is paying thousands and thousands and thousands of dollars in avoidable mortgage fees. Okay, so when you buy a house, you have fees. Okay, among those fees, there are discount points and origination fees. So when you go to Bank of America, for example, and you look at the mortgage rates today, for a $500,000 house, putting 5% down, you can see the rate. But see here, it has these are points. This is essentially 0.5% of 500,000. Actually, it's off the loan amount of 475. That's how much you have to pay in fees to get this rate. And if you go to Wells Fargo, okay, the rate is higher, and the points, in this case, they are calling 2,800. How did I see this? There we go. Okay. And by the way, this is with a 700. This is for Austin. Let me change this to Broward. All right. Okay, it's going to take me to the whole questionnaire, but it's going to be very similar to that. And those fees you don't have to pay. We don't charge origination fees. We don't charge underwriting fees. We don't charge the absurd amount of money that most companies charge in credit report fees. Let me stop sharing the screen. There we go. Okay, so most companies, especially if your credit is so-so, will charge you an origination fee, which is normally 1 to 2% of the loan amount. On a $500,000 purchase, that's $5,000. You don't have to pay that. You don't have to pay an underwriting fee, can be included in your rate. And the underwriting fee is between $700 and $2,500, depending on the company. We don't charge you. We include it on the rate. And the credit report fees, we're not gonna charge you that. At closing, you pay for the cost of your very own credit report when we pull credit, and in that way you don't have to pay anybody else's credit report. Mistake number 3, shopping before knowing if you can qualify for a mortgage. So when you are looking to buy a house, we are all guilty of this. We are gonna go on Zillow, Realtor.com, Trulia, Homes.com, start looking at homes. But we do this based on the estimates you see online, which are highly inaccurate. So when you start looking at homes, then you find what you like. Say that what you like costs $600,000, but then the reality sets in that when you get pre-qualified, you may qualify for just $300. And so now what happens when you do that? You exclude yourself from the search, you disqualify from it because your taste is that of a Rolls Royce, but you are working on a Toyota budget. So it hurts you. Your number one step should always get pre-qualified for a mortgage, or at the very least have an idea how much you're likely to qualify. So you look at a price range that reflects your financial situation before you sabotage your search, looking at homes that you can afford. Mistake number 4 will be trusting internet lenders. Bank of America and Wells Fargo, they did disclose in there that they were charging points and all of that. There are a myriad of other fees that they tackle on. And normally, it's the typical bait and switch. Mortgage companies do bait and switch techniques by giving you a very low rate when you get pre-qualified, when you apply. What's your interest rate? Oh, it's 5%. Oh, wow, that's really good. 5%. Yeah, everybody else is at 6%. Right. Is your interest rate locked? No, it's not locked. It'll change. Your interest rate will get locked the day you have a property. That allows any mortgage company to tell you whatever the hell they want to tell you. And they'll tell you, when you deal with people that are shady, they will tell you whatever they want to get your business. And the next thing that happens is that once you're under contract, once you put your deposit, once you spend the money for the inspection and the appraisal, and you put $10,000-$20,000 in escrow, the next thing that happens is that they tell you you don't qualify for that, and now you are on the hook, and you'll do everything in your power to not lose your deposit and not lose your appraisal and inspection money. Nobody wants to do that. So you will agree to whatever they tell you. And that, to this day, still happens. You see very low rates on internet companies, and they hook you. Mistake number 5 is with the same type of shady people. They give you very low in your loan estimate hazard and flood insurance quote. So if you're today, you can get in Broward, if you shop it, if you do your due diligence, you can get hazard and flood insurance at about 1% of your purchase price. You purchase a $500,000 property, you should be able to get insurance for $5,000 a year. Those $5,000 go into your monthly payment. So 5,000 divided by 12 is $433 per month that you will be paying with your monthly payment. Well, what if I quote you $2,400? Well, that's $2,400 a year. That's $200 a month. So that's a difference right there between company A and company B of $233. Because $200 a month versus $433, that's a $233. If you are not paying attention, then you'll get fooled. And the other thing that they will reel you in when you quote a low hazard and flood insurance rate, which, by the way, is your responsibility to shop, they will, within your closing costs, you have something called prepaids and escrows. Okay, prepaids is you got to prepay 1 year in advance. In this case, say I quote you the truth, 5,000. The shady mortgage people, they quote you 2,400. Okay, so now if you don't include the $2,400 on the estimate, my estimate will be $5,000 high. I told you the truth. The other people are not. Now, also, if they include $2,400, now their estimate's going to be $2,600 less, right? Not quite. There's going to be a more higher difference. You also got an escrow for 4 months. Okay, so 4 months of 433 is 1722, right? Or 1,700 and change, versus 4 months of $200, which is 800. So right there, you can see how you can see a huge difference in your loan estimates when somebody lies to you. And unfortunately, it happens every day. We see these when we are refinancing people and we compete with this for the business, and we see other people's estimates when we point out, look at this, look at this, look at that. That's how we discover all this stuff. So your job is your insurance will change substantially your cash to close and your monthly payment. You just gotta pay attention. The mistake number 6 is getting pre-qualified versus getting approved. What is a pre-qualification? Pre-qualification is, you call me, Alex, I make $5,000 a month. I work in XYZ, and I run your credit on a soft inquiry. Okay, run your credit, and I run just Equifax because it's cheaper, and based on Equifax, your credit score seems 626. It's above 620. You qualify. Good. And I tell you, yeah, you're good to go. Give you a pre-qualification letter. Pre-qualification letter is going to say you're pre-qualified up to a loan amount of $450,000 and an interest rate not to exceed X. Okay, that's all the information you get. Now you find a property below your pre-qualification amount, and you make an offer, you put a deposit, you start going through the inspections. Your lender gets now your contract. When they receive the contract, they start asking you documents. All right, I need to see your pay stubs, and I need to see your tax returns, and they ask you all the income documents. Every document that there's to be asked, they'll ask you for. You need your driver's license, social security, your last 2 bank statements, your last 2 W-2s, your last 4 pay stubs, your last 2 tax returns. When they ask you the documents, now they say, you said you made $5,000 a month, but that's comprised of maybe $4,000 on base salary and $1,000 in commissions. And you started working a year ago, and you have never worked on commissions before. Okay, you're not a salesperson. And now you cannot use that $1,000 in income because as a condition, you need to have 2 years, Fannie Mae requirements, guidelines, you need to have 2 years of commission income to be able to use it. Therefore, your income is now $4,000. The application original, you have $5,000 a month. Now your income doesn't qualify for that house. Loan denied. Second scenario that happens often when they run a tri-merge credit report. Now Experian, and remember we're running with Equifax, okay, so you have TransUnion and Experian. Now you have 3 credit reports. One was 624, which was fine, but the other one is 619, and the other one is 590. Guess what your middle credit score is now? 619. It's below 620. You don't qualify. So the safest way is you got to get approved. Furnish all the documentation. It's painful. Nobody likes to do that. Okay, but you gotta do the work. You're talking about a lot of money. When you do the inspection is going to cost you, depending who you select, $500 to $1,000 that you pay with your credit card when you do the inspection. You fail to qualify for that house, you never see that money back ever again. That's it, it's gone. You don't get a discount or a free inspection on the next house you buy. That money's gone. On the appraisal, same thing. You're going to pay, the appraisal is usually around $650. You are going to pay for that appraisal. The next thing that happens, that money's gone. So and then the seller, if you get a loan denial that is outside of your loan commitment period, the seller will claim your deposit, and then you gotta fight it. And depending who you use is what the outcome is going to be. So the safest way, guys, is just get pre-approved. Okay, actually get approved. You run, if you run a tri-merge credit report, you submit all your documentation. Once all the documentation is verified, the loan is submitted to Fannie Mae. Fannie Mae comes up with a thumbs up. You're good to go. Then you find a house based on the approval, what you actually already qualify. That way you don't expose your credit, you don't expose all the monies and you don't expose your deposit. Now, mistake number 7 is not understanding what your true buying power is. What is your true buying power? Buying power. Everybody says, hey, your pre-qualification said 450,000. So I must qualify for 450, right? Yeah, everybody thinks that. And that's because there's a lot of misinformation and there's not a clear way to demonstrate how much you qualify. That is not true. You don't qualify for 450 if that's what your pre-qualification dollar amount says. You qualify based on a monthly payment. So when you get approved for a loan, you get approved for based on your ratios. Okay, you have front end ratio and back end ratio. The front ratio, also known as housing expense ratio, is your monthly payment, the monthly payment for your house, principal, interest, taxes, insurance, mortgage insurance, and homeowners association. The addition of those 6 things is what you're going to get pre-qualified for or approved for. That's your monthly payment. Homeowners association has to be included in the payment, even though when you buy the house, you'll pay it separately. Now, you'll also, so that's your housing expense ratio. Now you have also debt, okay? And here comes the debt to income ratio, okay, DTI, as you may have heard. So the lower of the 2 ratios is what you qualify for. So when somebody tells you 450,000, well, one house has $6,000 a year in taxes. The other house has $1,000 a year in taxes. Okay, they are next door to each other. Okay, one has $5,000 less a year in payments, $433 less in payments. Okay, so you are more likely to qualify with the houses with lower taxes. But on the same scenario, you wouldn't qualify for that one because it has high taxes on the other scenario. So you qualify based on the payment. That's what I'm trying to say. And most pre-qualification letters don't tell you that. They only show you the loan amount and sometimes even the interest rate. So what ends up happening is that you end up wasting your time, framing, planning, making offers, touring, putting deposits on homes that you can buy. There was no solution for this, so I created one. I created my own software. When you are approved with Bluecastle Lending, you're going to have access to a software called InstantPQ. It's mine. I developed. I created it. And in there, when you browse on Zillow or Realtor.com or Trulia or Homes.com or Remax.com or Century 21 or Better Homes and Garden, in any major real estate website, from your computer through a Chrome extension, it's going to read the data and it's going to pull a little Bluecastle Lending Realty and Title icon. And it's going to tell you the payment for that house and based on your approval, based on what you qualify for, not based on a general estimate like Zillow or all of those websites have, based on your approval, and I'll give you the thumbs up or thumbs down. Also tell you how much money you need to buy the house. So if you need all the money, including down payment and closing costs, and it will tell you the crime in the neighborhood. It'll tell you the demography in the neighborhood, all the census data in the neighborhood, your commute distance to your points of interest, such as work, mom, dad, whatever you have in Google Maps. It comes up for every property. Then you click on it. It tells you how long it takes you to drive there, and the information about the city. Yeah, that's about it. So, and all the information about the schools from 2 different sources. It tells you the rent estimate based on also 2 different sources that you can choose and select. And it's pretty awesome because you're actually working with facts rather than guessing. So conclusion, you don't qualify based on a monthly payment. You don't qualify based on a pre-approval, based on a pre-qualification amount, or a loan amount, you qualify based on a monthly payment. The mistake number 7 is one of the most overlooked. People don't realize how important this is, including my own clients, even though I stress it very much. Your payment includes hassle and flood insurance. So if you're paying more in insurance per month, you're going to be paying in your monthly payment more. So your monthly payment, okay, if hassle insurance is, again, $2,400, is $200, right? The portion of the payment. But if it's $4,800, it's $400 a month in insurance. Your job is to get insurance for the lowest possible price. So the only way you achieve that is by a number of things that we teach you once you're under contract, how to shop, and you can get that to the number that I told you, 1% of the purchase price. Most people in Broward will end up paying 1.5% to 2% in their monthly payments because they don't shop, and they think that insurance people are salespeople. I own a title agency, okay, and soon a hazard and flood, a property and casualty insurance agency, and they're commission salespeople. Their job is we have all the underwriters, and that's what they tell you. That's not true. They have all the underwriters that they work with. Okay, in the United States, there are like 300 lenders, wholesale lenders that we're not approved with 300 wholesale lenders. We shop, we get the cheapest, the most user friendly, and then we assign, for each client, according to a number of things, which lender we work with, the one that will benefit that client the most. But we don't have 300 lenders, and many people will tell you that they have everybody, and that is not true. So shop for hazard and flood insurance. If you are my client, I'll tell you exactly what you need to do to get that for the number that I told you. Now, again, book a free consultation with me. We can go over your credit situation, your income, your assets, and whatever you need. We don't need to run credit unless you're ready to move forward, of course. And if you do the loan with me and you use us, Bluecastle Lending, Realty, and Title, and your credit, say right now, is low, we repair your credit. We get it to approval standards above 620, and we reimburse 100% of the cost of the credit report fees. So with us, it's $150 a month that you pay every month. And my job is to clean that credit up as fast as possible, because I really don't care about your $150 per month. I care about getting you approved for a mortgage. Because it was an illegal, unauthorized practice of law for us to do it for our clients, I had to form a credit agency. So now, okay, you pay that, we're under the law, but then we reimburse 100% of the cost of the credit repair, up to $1,500 when you use us to buy the house. Also, if you don't need credit repair, we pay for your movers. Yes, you heard that right. Your movers. You're going to have moving expenses. You bought a house, right? Well, we're going to give you a credit up to $1,500 for you to pay the movers. You present after closing. We're done. You close. You got the keys. 3 days later, you got to pay the movers, or you pay the movers. You present your receipts to us, and as a way of thanking you, we will pay that bill for you. We'll sell you the money. It's just thank you for your business. Please refer us, and then once the rate goes down, okay. Once the rate goes down, and say that your interest rate right now is 7%, just to make up an interest rate, or 6, and then now the rates are 4. Okay, within 3 years of ownership that you bought with us, we refinance you for free. We give you a credit up to $2,500, So you essentially that covers for most cases most of the cost of refinancing. Also, for those that are short on the cash to close, we give you we can give you a lender credit up to 2.5% of the loan amount. So if the loan amount is 500,000, 2.5% will be 12,500 bucks. Okay, so you use that to purchase the home for the closing cost. So what is a lender credit? A lender credit is we work on a fixed commission as a mortgage company. I set it up that way so my people don't get greedy. We make the exact same amount of money whether you pay 6 or 7%. There's no difference to us. So what happens if you pay 7? All you get lender credits instead of, and a lender credit is the commission that we would have made ourselves if we would have kept 7%, which is what everybody else, every other mortgage company does. Okay, we give it to you in the form of a lender credit. So you use that money to purchase your home to reduce your cash to close. And we can do that up to 2.5%. And then you utilize between month 7 and 36, you utilize the credits and you refinance and it costs you nothing. Again, that's our way of saying thank you for your business. So what are the steps? And this is the last the issue I'm going to cover, and then I'm going to go for answering your questions. What are the steps to home ownership, steps to buying a house? First, number one, you need to get pre-qualified. Then you submit all your documentation, and then you get approved. Okay. Then you gotta go find a house. So when you work with us, we do the search on the MLS, you get the listings, the emails, etc. And you gotta select the houses, and then we go and visit them. Then when we make, the next step will be to make an offer. Let's assume you like a house. Okay, when we make an offer, you're not gonna make, I'm not gonna talk about money because it's really what most people care about. When you make the offer, most people will ask you a deposit. We don't ask you any deposit. Okay, you give a 0, you make the offer, and the deposit will be due once the offer is accepted. Normally, the deposit is 3% of the purchase price. On a $500,000 property, that's $15,000. On a 300, that's $9,000. Then the contract will be contingent on financing, which means if you don't qualify for a mortgage within the allotted time in the contract, normally 21 to 30 days, you get your money back, the deposit. It's going to be contingent on appraisal. Appraisal is the valuation that the bank is going to do to make sure that the collateral is worth what you are paying. So you want to pay $500,000 for the house, that's great. But if the house is worth $450,000, the bank will base all the numbers on $450,000. You can pay more if you like to. If the property, you can pay $500,000 if you like, but the bank will give you the financing based on a $450,000 valuation. So if you're putting 10% down, your loan amount will be then $405,000. So it's going to be $450,000 minus 10%, $45,000. So that will be $405,000. And if you keep the purchase price at $500,000, now you'll have to bring the difference, $95,000. So the contract will be contingent on the financing, on the appraisal, and on the inspections. On inspections, you select the inspector and you pay the inspector when it does the inspection, normally between $500 and $1,000, depending who you use. The best way, we go over with you, the best way to find an inspector that you feel comfortable with. Inspectors are going to miss stuff that is wrong with the house that you will discover after you move in. For that reason, we don't refer anybody. We tell you how to shop, and then you select whoever you feel more comfortable with. And then the closing will be 30 to 45 days later. So once the seller accepts the contract, the next step is to put the deposit. Remember that 3%? So on a $500,000 purchase, you put $15,000. Then you do the inspections. okay, within 7 days of the contract being accepted. Then you do the appraisal. The appraisal will be ordered by the bank. The bank selects the appraisal, not you. You will have to pay. Normally, you pay, by the way, you pay the inspections and the appraisal with a credit card. So it's just so you know. And then you're going to have to provide, you remember we talked about the approval? Okay, the next step is your loan gets submitted with the property, with the appraisal and all of that, and the underwriter looks at all the documentation and it's going to come up with contingencies. The loan is going to come up approved with contingencies. Contingencies could be a letter of explanation as to why your job is less than 2 years. Another letter of explanation as to, a credit inquiry that you made, a new bank statement, or source this deposit, or something will have to do with your job. And the sooner you will clear those conditions, the sooner your loan will be cleared to close. It is contingent. So the bank approves your loan contingent on you providing all the stuff. So these days, you cannot get away with anything that is false. Usually everything's going to have to be verified. And then you're going to have to provide homeowners insurance coverage. Okay, it's your job to show up. We'll teach you how to do that. But then you will have to get hazard and flood insurance. Flood, if you're in a flood area. If not, it's just hazard. And the hazard in Broward includes windstorm, which is for hurricanes. Then you're going to arrange for the movers and 30 days later, you're going to close. At closing, you're going to wire the balance of the total amount of money that you needed to buy the house. So say that you need to bring, I'm going to make up a number, $30,000. You already have wired for the deposit 20. Okay, on closing date, you're going to have to wire the balance. Okay, the title agency will tell you, okay, we need $9,923 with 53 cents. Okay, you're going to have to wire that. Now, these days, there's a lot of scammers that are monitoring real estate agents, title agencies, lenders, emails that they have a bug inside them. So when there is a closing, if one of those people, it's a victim of these scammers, they will email you saying, hey, please wire this much at this account. And it's not the title agency. Okay, you may have a bug in your computer, and some way, somehow, and a scammer got a hold of it, and that happens. It has never happened to me, thank God, but it happens every day, in the United States. So what happens is you, as a consumer, you get notified, wire the $9,982 with 25 cents to. And they give you the wire instructions. And for the purchase of this property, 123 Northwest 4th Street, it's all good, fine and dandy. And it all seems legit. The only thing is that you're wiring that money to the scammers. So how do you avoid that? Before you wire the deposit, okay, you need to call and verify with your realtor and with me or the title company, hey, these are the wiring instructions. Okay, you need verbal confirmation on the last account, on the last digits of the account number, so you don't get scammed. Okay, very important. It happens every day. Don't be a victim. So you wire the balance. You're gonna go do a walkthrough inspection. The purpose of a walkthrough inspection is to walk through the house. You're not doing a new inspection. Okay, basically you're verifying that the property is in the same condition as you saw it, and as the same way there was noted during the inspection report that there is no new damage and that the seller didn't take the appliances. That has happened many times, and that the seller didn't take window treatments. It happens every time. So that's what you're verifying. You open every faucet and you flush every toilet, make sure that nothing is, leaking. That's it. no new damage, everything stay the same, good. You go to the closing and you sign away. At closing, you're gonna get your keys, okay? And now you're gonna be a happy new owner. You're gonna take your pictures, and the next thing is to move. So hopefully you would have arranged for movers, and we pay for it up to $1,500 of the cost. Actually, the math is 0.00375 times the loan amount is exactly how much money we pay. Now, let's assume your rate is 7.25%, okay? Because you took 2.5% in letter credits, and 7 months later, okay, we can refinance you, and the rate is 5.5%. Okay, that makes sense. So we refinance you, and your new rate will be 5.5%, and we'll cover all the closing costs again up to $2,500. Okay. Write down again my phone number, 954-866-0000. Now if you guys have questions, let me see if I can unmute you guys, or unmute yourself. Can you unmute yourself? I'll gladly answer any questions you may have.